Welcome back folks, this time I will be covering a top-down analysis from the weekly chart to the 1-minute chart in order to get our bias. This example is based on a trade that I took on my Top Step X evaluations. I hope that you enjoy it and learn something from it. So let's dive into it. I will introduce you the power of 3 concept that ICT teaches. This concept is based on the formation of a candlestick. In general, we will use it on the daily chart to get our daily bias, but it can be applied to other time frames too. When the candlestick opens, it will start accumulating orders above and below the marketplace. We can use the midnight opening price on New York local time as our reference point in order to know where we are in terms of the daily candlestick. If our bias is short, ideally we want to be shorting above the midnight opening price, since this is the manipulation or Judas swing that tricks uninformed traders to long, engineering more liquidity below the marketplace, where smart money will distribute their orders during the distribution phase. If you study the formations of the daily candlestick using the 15-minute chart and having the midnight opening price as a reference, you will be shocked by how this works. Don't have to believe me, just look at your own data. We will start our top-down analysis with the weekly chart. To begin with, you must know that we have entered a seasonal tendency and a quarterly shift. That is why my focus was on that discount weekly fair value gap that remained unfilled, next to a bullish order block. I was expecting price to reach for this fair value gap this week, and in fact, it did. Moving into the most important time frame if you want to have an accurate bias. The daily chart. This is my daily chart. It is divided into the ICT data ranges. If you want to learn more about ICT data ranges, you should watch ICT's core content. But basically, our 20-day ICT data range showed a huge sell-side liquidity pool below the marketplace. In fact, we were trading inside of a daily inversion fair value gap. Plus, we had moved with energy to the upside and with the same energy to the downside the next day. This indicates that the move to the upside was engineered to sweep liquidity and used by smart money to sell. So, I was expecting a down close candlestick to print the following day in order to attack those sell stops. Eventually, it melted down into the sell-side liquidity pool. But if you look closely, the candlestick was first moving to the upside before moving down. This is showed by the wick above the opening price, which is the Judas swing that I showed you on the power of 3 slide. Let's have a look into that wick on a lower time frame. 4-hour chart. Look at where price was in terms of premium and discount when it started moving up at the candlestick open. It was moving up into a premium 4-hour bearish fair value gap. And look at the reaction that price offered once it traded into it. 1-hour chart. Here things start to clear up a little bit. Look at that hourly fair value gap showed in the lower half of the 4-hour fair value gap. The move above the midnight opening price was used to send price into that hourly and 4-hour fair value gap. Plus, we have a huge sell-side liquidity pool below the marketplace where retail traders believe that their sell stops are safe, since they see that as support. This liquidity pool will act as a magnet for price, since it will seek that liquidity. 15-minute chart. Here we can see how slow and efficient was that move to the upside into the hourly fair value gap. This move is seen as a low resistance liquidity run, which means that price will post energetic candlesticks to raid that liquidity. I want to pay special attention to this shaded area, so we will zoom into it. Now you see what I'm talking about. Going into the hourly fair value gap was a buy-side liquidity sweep that smart money used to sell. Besides, you can see a market structure shift where the light bulb is, with a fair value gap. Also, I noted the opening range gap low that we covered on the previous video, since it will act as a magnet for price too. This shows how many things are suggesting that price should move lower, so we just have to wait for an entry on a lower time frame, although you can short this fair value gap if you trade the 15-minute chart. 1-minute chart. Here we have the real sauce. Look at the turtle soup inside of the hourly and 4-hour fair value gap. Then the displacement that occurred at 9:30, creating the market structure shift. What I did was wait for price to go into the 15-minute fair value gap, which was a turtle soup on the 1-minute chart, as you can see. Then I wanted to see some displacement to the downside, which was offered with a beautiful fair value gap that I used to short into the first sell side liquidity. Ideally, you should leave a runner to capitalize the whole move into the low resistance liquidity run low and eventually into the daily sell side liquidity pool. But I look for low hanging fruit targets. Take into account that these arrows do not represent a trade. I traded from the Top Step X platform and I honestly don't know how to show the real executions in there. This move offered a potential 100+ handle trade in a couple of minutes. Put the work into it and you will be able to participate in them. This is the end of this video. I hope that you learned how powerful is using a top-down analysis to frame our bias. Remember that you need to put effort and time on this craft in order to be successful, and if you made it to the end of this video, you have the right mindset to become a successful trader, since many of you don't even have the patience to watch a 5-minute video without getting bored. Study and learn, you will make it. Thanks for watching, and until next time, be safe and good trading.